When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave, Chase, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Welcome to the Retire Your Way podcast. I'm Ron Stutz along with Dave Lopez of ILG Financial. Income, legacy, growth, it's all right here at ILG Financial. And we are here to talk about getting you to and through retirement. And Dave, first of all, it is great to be back with you.
You too. I always like our time together and sure love putting this information out I love how we can do it in a more of a conversational matter as opposed to a classroom setting.
Oh, absolutely right. And if we were in a classroom setting, I probably would fail. I wouldn't do very well in a classroom setting. So much rather have a conversation.
Maybe that's more of an indictment on my teaching ability than on you as a student.
No, I was a terrible student. Hey, let me just say right up front here for everybody, if you'd like to get in touch with Dave Lopez, you can call 540-720-5656. That is 540-720-5656 and have a conversation that's not going to cost you anything. You know, Dave, in 1981, a long time ago, we saw the bond market inversion reach its steepest point, which is often seen as a sign that a recession is on the way. Over the last couple of years, the possibility of a recession has been all over the news, but the curve has been inverted for a year now, which raises the question, is this recession actually coming? What exactly is an inverted yield curve, and what does it have to do with a potential recession?
Yeah, that's a great question. One of the reasons we're doing this podcast, Ron, today is we're getting this question a lot. And I'll tell you what, I just said this yesterday to a client in the office. I go, our industry, the financial industry, has a gift for taking relatively simple concepts and explaining them in a way that I guess they either make us seem smart or make other folks think that it's too confusing. And I don't know if that's intentional or it's just the people who put these ideas and gave these things names went out of their way to make them more confusing than they could be. But
just makes it more complicated, right?
It makes it more complicated than it needs to be. So if we can do our job right today, we're going to try to explain yield curves and inverted yield curves and normal yield curves in plain English today. So what I'm going to ask you to do as we go through it, since our listeners can't call in, is jump in, interrupt me, stop me if something doesn't make sense. Because the point is, I want it to make sense to you and to the folks listening.
Okay, that sounds good. Be prepared to be interrupted a lot.
Yeah, so let's kind of talk about it. So the economy, it's true, and we'll talk about what an inverted yield curve is here in a moment. But usually when you see an inverted yield curve, it is a harbinger that maybe a recession is on the way. And you'll see by the end of this podcast why people think that.
Okay.
The economy so far in the last year or two since they've started dropping interest rates has been much more resilient than anyone expected. Now, with that said, that's on the short term. That really doesn't mean anything. It just means, we've lasted a little longer than we thought. It doesn't mean that a recession's not coming. And it doesn't necessarily mean that one is coming. So what we'll do is we're going to take a look at exactly what's going on with the yield curve, talk about the factors that can cause it, and why people think it's usually a harbinger of a recession, and we'll just kind of go from there. And if you have any questions, kind of jump in.
Well, first of all, let me ask you, what exactly And explain this one in a very simple way, if you would. What is an inverted yield curve?
Yeah, so you know what? I think the best way, let's start by saying, what is a yield curve? How's that sound?
Okay, sounds perfect.
So think about this. Whenever you're talking about a yield, yield's, again, fancy talk for just meaning return or interest.
Okay.
Right? So if you said, hey, I've got a bond, Dave, and I've got a 5% yield, and people go, well, what's a yield? Okay, well, that's the return. You're getting 5%. So on $1,000, you're going to get $50 a year.
Okay.
Make sense?
Sounds good.
So a yield curve basically says, hey, we're going to plot. Some people can borrow money for, you could have a CD for 1 year. You could get a 5-year CD. In theory, you could get a 10-year CD. Same thing with bonds, right? They're all just people borrowing money. Agreed?
Okay.
So a yield curve basically is how much interest am I going to get on a 1-year CD and how much interest am I going to get on a 5 or a 10? Well, a normal yield curve, and I wish this was a video, but we'll talk a little bit about that. A normal yield curve, think of it as, if you're looking at a graph, a diagonal that is trending up.
Okay.
Make sense?
I got you.
So it's lower in the beginning and it's higher in the end. So all they're saying, and then at the bottom of your graph, the horizontal line is time, how long you're loaning the money. And then the vertical line on the graph is your yield or your return. So as the diagonal goes up over time, what they're saying there is, if you're going to loan money to somebody for a longer period of time, you would only do that if you're expecting better interest than you can get by loaning the money for a shorter period of time.
That makes sense. Yeah.
Right? Why in the world would you loan somebody money for 10 years and get 4% a year if you can loan it to someone else for 2 years and get 4%?
Yeah. That makes
perfect
sense.
Yep.
Yep.
If you're going to let someone control your money for a longer period of time, the expectation is that they would have to pay me more interest to do that. Mm-hmm. That's a normal yield curve.
Okay.
Right? The longer period of time you're going to loan the money, the higher the expectation of the return you should be getting yearly.
Okay.
Now, with that said, that's a normal yield curve. An inverted yield curve, imagine if you've got that picture still in your head of the graph and the diagonal line trending up. Right. An inverted yield curve or a flat yield curve would be just a horizontal line, right? And that would be, hey, the interest rate on a 2-year note is 5%, and the interest rate on a 10-year note is also 5%.
So what we're seeing right now is really kind of an unusual environment.
Yeah, that's right. An inverted yield curve then would be trending a little bit down. So maybe a 2-year note would be 5%, but a 10-year note might be 4.5%, a little lower.
Yeah.
Right? So why in the world, again, would you lock your money up for 10 years for less interest than you're getting now? We'll talk a little bit about that. So that's an inverted yield curve.
Okay.
Okay.
This is really not a normal situation that a lot of people we're having trouble understanding this. I mean, I'm having trouble understanding this.
It is, but if I do my job right, we won't by the end of the call.
Okay. Sounds good to me.
Let me throw this in because I think it might be, I know it's so difficult to visualize what I'm saying, and we just don't have the benefit of video. Luckily, though, Chase and I have done a short YouTube video on our Retire Your Way video series that's on YouTube. And it goes into this in depth, and I think it'll help if anyone's listening to this and they want to just take a 10-minute and see what we've got to say about that. Just check that out. If you don't know how to do it, you can go right to our website and click around till you find podcasts and find it. You can also go to YouTube and just hit, search ILG Financial, and you can pull our what do you call that, a page on YouTube?
Mm-hmm. I guess.
And then find the one on yield curve, and if that's you're not used to doing that, just pick up the phone and call us or email us, and we'll send you the link. So take advantage of that. If this is of interest to you, watch that again, and then if you still have questions, of course, feel free to reach out to us.
So, Dave, let's take a look now at what impact all this might have on a potential recession.
Yeah, so just walk through what an inverted yield curve is, right?
Okay. Yeah.
What does that mean when people are trying to make a diagnosis of what that means for the future, whether it's the economy? So, again, the basic definition, I just want to reiterate this. is that an investor, which would be you, if you're loaning your money out, whether it's for a CD or a bond, you expect interest rates to be higher in an inverted yield curve than you expect them to be down the road in 10 years.
Absolutely.
It's the opposite of how it should be, right?
Yeah.
And the people who are asking to borrow money for you, so it would be a bank if you were issuing a CD, or a company if a company was issuing a bond, or the federal government if you were getting a federal government bond. What they're saying is they're expecting interest rates 10 years down the road, these interest rates to actually be lower than they are now.
Mm-hmm.
Right? Normally, that's not the case.
Yeah.
Right? Typically, investors will demand a higher interest rate for longer term on bonds because they're parting with their money over longer periods of time. We've already said that.
Right.
Right? If traders, right, that's the person who's offering you the bond or offering you the CD, are willing to charge you, Ron, a lower interest rate on a longer term debt, they're thinking that the Federal Reserve is going to slash interest rates.
Yeah, I would think so.
Right? Now, the result of slashing interest rates is usually what the Federal Reserve has to do if the economy has weakened.
Okay.
Right? You cut interest rates because you want to rev the economy back up.
Mm-hmm.
So when you raise interest rates, guess what they expect to happen to the economy?
It's not going to do too well. But
They want to slow it down, right? And you're seeing that today, right? You raise interest rates and all of a sudden people can't buy houses anymore because the interest rate on the mortgage is too high.
Yeah.
Well, that slows the economy down, and it slows the economy down on anything anybody would have to borrow money against. So we raise interest. The Fed usually raises interest rates if they're trying to slow the economy. And why would you slow the economy? To try to get a hold of inflation, right? You lower interest rates if you go into a recession and the economy slows down too much, right? And you want to rev it back up. Right?
Makes perfect sense.
Yeah, so an inverted yield curve means they're expecting interest rates to drop, not in a year to two, but maybe after 2 years, interest rates to start to drop again, which means they're expecting a recession in which the Fed would have to respond by lowering interest rates.
So what does the future hold when it comes to a recession? We've been talking about potential recession here, but it sounds like there's a strong potential for that to happen. But what's going to happen in the future?
Yeah, so here's where we are currently, right? The Fed, right now, the folks that are loaning money out, and this is what's resulting in this yield curve, they're expecting the Fed on the very short term to keep raising interest rates a little. And as of us recording this, they just raised them again. But the 2-year, give you an example, the 2-year yield, right? The interest for 2 yield is almost 5% now.
Yeah. Okay.
Right? It was around 3.8 in April. That's a huge rise.
So that's really jumped a lot since
That's right.
March.
Now, think about this. The 10-year note, the yield is now about 3.8%. It was 3.3 in April. So what you're seeing there is the 10-year notes have barely moved at all.
Yeah.
But the 2-year have gone through the roof. Well, again, now you can actually get better interest on a 2-year note than you can on a 10-year note.
That is really interesting.
Right, and what that tells us is the people who are borrowing money for you or issuing CDs or bonds, they don't want to lock in to guarantee to pay you 5% for 10 years if in 2 years from now interest rates plummet.
Yeah.
So they're expecting the Fed to cut interest rates after a year or two and have them trend back down again. By the way, this is all just guessing, right? But that's our guess too. And there's another reason that adds not just speeding up or slowing down the economy, but you want to always keep this in mind. Remember, the Fed controls interest rates, agreed?
Yeah, absolutely.
Also remember, think about this. Who is the biggest borrower in the world?
The biggest borrower in the world? I don't know, but I'm sure you're going to tell us.
Well, it's the United States government.
Oh, yeah. Well, I was going to say that, and I thought, no, it can't be that simple.
You're right on it, right? And if there may be a couple countries, China or something, that may be up with us or maybe above us, but you get the idea, right?
Yeah.
With our debt at $32 trillion and rising, they're the biggest borrower. Well, that's a problem, right, if interest rates go up, because they've got to pay interest on their debt just like all of us do. Make sense?
Yeah, makes
So
perfect
think about
sense.
this. If you could control the interest rate on your credit card debt that was very high, would you want the interest rate higher or lower?
I would want it lower.
Right. So imagine, in our opinion, the government's raising interest rates, and they hate to raise interest rates because their credit card rate goes up, right? They only raise it to stop inflation. Once they think inflation's in hand, in our opinion, they're going to immediately try to lower rates as low as they can get away with for their own benefit. Now, they'll say it's for us and it juices the economy, and that might be a side effect for us personally. If your credit card goes down, if they lower interest rates, and you could maybe refinance, and that helps. But they have a major problem on their hands if interest rates go through the roof.
Yeah, absolutely.
Right? Imagine $32 trillion on your Visa. Right, and interest rates go up, you've got a problem, don't you?
Yeah, I'm sure. And it's amazing you point out that it's really, they paint it like it's, we're doing this for you. But, actually it's self-serving.
Human nature, isn't it?
Yeah.
So I want to get back to your question, which is, what does this kind of mean with maybe a potential recession, right?
Okay.
So traders have kind of raised their expectation for the federal rate hikes. They think they're going to keep them up maybe one or two times. Maybe the rest of this year we might get another hike, right? But that's all on the near term. But they really haven't changed their expectation that on the long term, the Feds will probably try to turn interest rates back down. Does that make sense?
Yeah.
Now, that might mean as they raise these rates, they're expecting a recession. Higher interest rates now will push down the economic demand for goods, and we slow the economy down. And if we slow the economy down too far, the Feds will then cut rates to try to juice the economy.
It's beginning to make sense to me.
Yeah.
Dave. Thank
Sometimes
you
we
very much.
have to say it a few ways. So it could mean an inverted yield curve could mean on the short term, the folks that are betting that we might slow the economy down and possibly slow down enough that it would be called a recession.
Okay.
And then that would trigger lowering of interest rates moving forward.
All
Right?
right.
If they thought the economy was going to continue to roar forward, then what would the Fed do to stop inflation? They'd have to keep raising rates.
Yeah, exactly.
Right, so an inverted yield curve says the people in the know who have all the data that are betting their money on it are betting that the interest rates aren't going to keep going up much. Now, how long? And maybe one or two more increases, maybe three or four, maybe one. Right? But they think they're about the end of this historically dramatic interest rate hike we've seen over the last 12 months.
Boy, that's
and
good.
then they'll start to go back down, right? Okay, so because they don't want to keep rates high forever, right? So if the Fed raises interest rates enough in the short term to bring down inflation, they want to do it. The ideal would be for them to do that without crushing the economy, without sending it into a major recession or a depression.
Well, let's hope so. Yeah.
Right? Imagine you've got your hands on the levers, adjusting water going in and out, right? And you need to let enough water come in to relieve the pressure in the tank, but not too much so that the tank empties.
All right.
Right?
Yeah.
So that's what's going on here. The Fed's trying this. You may have heard on the news them talking about the Fed trying to create a soft landing. Have you heard that term?
Yes, I have heard that a lot lately.
Yeah, so it's like an airplane landing. Again, another analogy. What they're trying to do is slow the economy down, but not so fast that the airplane crashes into the ground. They just want to slow it down so it hits the runway and rolls, and then they can, once it slows down, before it crashes, then they can lower interest rates a little bit to juice it a little so things just keep rolling.
Control it a little bit better.
A controlled descent, right? It's very difficult to do, as you might imagine. And whether they pull it off, that's what everyone's betting on, right?
Okay.
So if you raise interest rates too much, too high, you could create a recession. Remember the bank problems we had a couple months ago?
Yeah.
That was because the interest rates went up so far, so fast, in fact, more than they ever have and faster than they ever have historically.
Really?
That the banks, the way they had their reserves set up, I mean, many of these banks that had trouble, the money was literally sitting in government treasuries. But it was in 30-year treasuries, which when you raise interest rates that much, those treasuries become worthless if you have to sell them early.
Yeah.
Well, they had to sell them early because people got scared and had a run on the bank, and when everyone wants to withdraw, they had to pull out. pulling out of the 30-year bonds isn't a major deal unless interest rates skyrocket, and they've never skyrocketed that far that fast. So it could be argued that the Fed created that mess with the banks.
You know what this all reminds me of? That old saying that perception is reality. When people start to perceive certain things, it becomes reality.
You're exactly right. In fact, in this case with the banks, it's true. There were a couple articles that said, hey, the reason those bank runs happened, you know what they blamed? The iPhone.
Oh, yeah.
They
really?
said before the iPhone, imagine 30 years ago, we would have had to have read it in the paper, then decide if we wanted to go down to the bank and make a withdrawal. Right now, somebody hears something, they immediately tweet it or send it on any of their social media to everybody they know. So immediately everybody knows it. Everybody's got their bank information on their phone, so they can immediately request a withdrawal.
All this information is at your fingertips, and you can
too fast, too quick,
away.
Right? The banks couldn't react. It was too fast. If they had just been able to do slower processing, it would have been fine. So that's a different podcast. I don't want to get off track. So we're talking about the yield curve, right? Mm-hmm. So with this inverted yield curve, we're expecting a slowing down of the economy, and then hopefully not too much. And then once the economy slows down, they'll start to lower interest rates again.
So getting back to our original topic here, we talked about a potential recession, a possible recession, a lot of people expecting one. I'll ask this question again. What does the future hold when it comes to all of that?
Well, I know you don't want to hear this answer, but
It depends.
You'll find it consistent with what we've said, which is nobody can predict the stock market, the bond market, the economy. No one can predict short term what's going to happen.
You mean you don't have a crystal ball?
I do not have a crystal ball, and if anyone tells you they do, I would suggest you run, because no one has been able to prove to be that prophetic on the short term. Right. Just want to remind you what we've said several times on this podcast. Warren Buffett, when it comes to investing in the stock market, says if you're not willing to put your money in and leave it untouched for 10 years minimum, you have no business being in the market for 10 minutes.
Yeah.
And I would say the same, with things like the economy. If you're trying to predict the economy on the short term, you can try to predict it and you can make bets. Everyone does that, but it is just a bet. There's too many moving pieces on the short term. And on the short term, there's too many things that are happening based on, like you said, perception, fear, and greed.
So it sounds like it's going to be a while before we actually know what's going to happen in the future, right?
That's exactly right. So you just have to stay tuned, keep watching how things develop, right? But really what you want to be thinking about with your financial professional, Ron, is if a recession's coming, let's plan for it. How does it affect me? Mm-hmm. Right? There's an old saying that, recessions are individual. And what I mean by that is if you're coming home from work and we hit a recession or a depression, if you didn't lose your job, you're not experiencing a depression or a recession.
Right.
Right? If you lose your job, you're experiencing a depression. Right? So it's all relative to your individual situation. So you want to get with your financial professional and say, hey, if it looks like there's a possibility here we could move into a recession. How does that affect me? How does that affect my plan that we're working on together? And are there any tweaks we need to make to the plan to account for that contingency?
You need to be prepared for whatever happens.
You need to be prepared, right? One other takeaway I'll give folks, because this comes up a lot, is what you're seeing on the short term with CDs and high yield savings accounts and even 1 and 2 year bonds are pretty good rates compared to what we've had over the last 20 years, 4 or 5%, which is great. But it's only for those short terms. 2 years or less is what you're usually seeing.
Right.
Right? And what will happen is after that period runs out, if interest rates drop back down, you're stuck with that money sitting back in the very low interest rate environment that you were in before. Which is very difficult to move forward if you're not even keeping up with inflation. Right? There are investment strategies that you can take advantage of now that interest rates are higher that can give you a chance for much more than 6 months or 2 years to do better and still have that principal safety that you're looking for in a CD or a bond or something. But you have to look a little further than just going on the bank. There's several strategies. If you're not aware of them, give our office a call, set up a phone call with Chase or I. We can kind of walk through some that are available and see if any are a good fit for you. But you've got to look into options. If you don't, you're just going to be limited by what you know, and you don't want to be limited or lose money or lose future returns just because you failed to look at an investment opportunity that might have been a better fit under these new economic conditions.
So there are opportunities out there for folks, but you have to know about them. And, Joe Blow is not going to know about these things. You need to get in touch with a financial professional like Dave Lopez or Chase Lopez and at ILG Financial and find out about these things, because there are lots of opportunities out there, as I said, but, if you don't know about them, they're not going to help you at all. And these folks can help you take advantage of those opportunities.
Yep. You just want as much information as possible. You couldn't have said it better, Ron.
Great explanation today. I explained it. I explained it. I didn't explain it at all, but I understood it. I understand it a whole lot better now than I did when we started our conversation.
Well, great. I hope the folks listening feel the same way. And don't forget to check out that YouTube. You can get it right from the website, or give us a call or an email. We'll send you the link if you want to see it on a visual form, this explanation of inverted yield curve. We're glad to pass that on to you.
If you want to understand the inverted yield curve and potential recession, inflation, all of those things, all you got to do is get in touch with ILG Financial. And let me give you a very important phone number here, 540-720-5656. Income, legacy, growth, it's all right here at ILG Financial, and it's about helping you plan for your retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656, or you can go online to ilgfinancial.com to learn more. This has been the Retire Your Way podcast. I'm Ron Stutz with Dave Lopez, ILG Financial, and we thank you so much for listening. We'll be with you again very soon.
Talk to you soon.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.